Welcome everyone to the Kendall Report for Monday, December 9th, 2019. There's just going to be two more Kendall Reports. There'll be today's and then there will be next Monday, and that will be it for the year. As far as commentary goes, there will be commentary all week, and then next week will just be Monday only, and that will be it for the balance of the year. And I typically take off the last couple weeks of the year and then resume the first full week of 2020 in this case, and I believe that starts on. Then we'll resume on Monday, January 6th. The holidays come during the middle of the week this year, so it'll be very disruptive, but we'll resume on Monday, January 6th with normal commentary. Let's go ahead and dig in and look at the events that are going to happen this week. The very first thing that I do want to mention, on Tuesday we have the FOMC meeting. The Fed will be meeting for the final time this year. Expectations are for them to do nothing, and those are my expectations as well, but they do have a conference scheduled, which suggests that we're likely to see some sort of restatement of what we've already heard, but to put the market and set the tone for the markets as we come into 2020. One of the surprising things that I think that will happen in 2020 is we'll actually see rate increases, not rate decreases. And we'll talk about that when we get into the interest rates, because there's some very significant things that are starting to show up on the Treasury charts. And we'll go through that shortly. As far as this week goes, the other elements that will be out this week is CPI, which is expected to show about a 2% year-over-year gain, which is a slight uptick from 1.8. So we'll see how that plays out. I don't expect that to be material. On Thursday, we have PPI, which is expected year over year to show a 1.7% increase. As far as everything else goes, it's pretty mundane. The only other thing that sets up is Friday's retail sales will be watched fairly closely, but you have to think about it. It won't be as important as when we see this report in January, because we'll be looking at holiday sales, which everybody will be triggering off of, and there'll be some rhetoric flowing around that over the next several weeks. But as we look to end this year, the next 2 weeks are the last full weeks of the year. We're going to see a fair amount of activity, I expect, especially after a year that's up 26% plus. And we're likely to see a lot of squaring of books. And I just want to mention, those of you using the VPM software, watch out for any kind of distributions, any kind of elements that are in on the mutual funds that maybe the chart looks odd. We usually catch most of them, but if you see something, please make sure you send in a report off of the software and let us know that there's an issue. You can send that to support@vpmpartners.com if you see anything strange in data. I would be very careful if you see a big drop in prices when you know the market hasn't dropped, then that's probably likely a distribution. So anyway, as we look at closing out this year, we had a huge year. It's been pretty amazing, actually. My expectation is for a continuation of what we've been seeing. I'm going to do a 2020 outlook sometime during this week. I'm going to do a video presentation of my expectations for the outlook for 2020 and give you at least some ideas from a technical viewpoint, and we'll talk about some fundamentals that I think that are going to happen as well at that time. So let's go ahead and take a look at the technicals. As we look at the daily S&P 500, you're going to notice that a week ago Friday we saw a sharp drop, and it followed through on Monday, and we printed all the way down to the 3070 level, and the market reversed on that Monday. As I've said during commentary, that I thought that was a low, and we've all finished at an all-time new high on Friday. We saw unemployment numbers come out on Friday, knocked the wrapper off the ball again, and it continued to defy logic from the standpoint of at least the economists. You'll also notice, just a note here, is that a lot of these economists that were calling for recession, all of a sudden they're gone as far as that goes. they're not calling for that anymore. Somehow we magically avoided it. There was never any signs of it. The only thing was a single factor that just about everybody in the markets grabbed a hold of and started predicting the recession. I rattled on about this several months ago, actually back in June and July and August is when I was really talking about this. Not going to be a recession. The single factor was that the yield curve inverted. And I'm going to show you something really interesting when we go through interest rates today. But this market screamed right back last week, closed at an all-time new high. And there's objectives that I've been talking about in commentary I'll mention here, is that the minimum objective is 31.57 to 31.72. I suspect we're going to see some sideways trading here for a couple days, remaining above the 31.30 level during this time, and we could just continue to move higher, but we're gonna just stabilize here ahead of the Fed releases on Wednesday and the conference call. I don't see anything else material that anyone's going to be watching other than that event this week. That is the big event, and everybody will be listening in on the call, and the announcement or the statement that's released on Wednesday after the meeting for some type of guidance. I expect to see them continue to move higher. I talked about some numbers on commentary that a close over the 31.40 level would indicate at least another 2 to 3 weeks of higher prices. So my expectation, therefore, is to see markets continue to move forward as we go get closer to the end of the year. I don't see them backing off of here. Now, it depends on where we get and how high we get will determine on how the 2020 year starts. So we're at these unbelievable levels, and this could set the tone for some backfilling, but it looks to me we're going to continue up into the 32 handle, maybe as high as 33 handle over the next 6 to 8 weeks. So we're going to see quite a bit of strength in the markets. Let's take a look at the weekly chart, and you'll see that the weekly also had this huge reversal pattern. You'll notice over here, literally bounced almost exactly off of the 10-week moving average. It screamed off of there. We closed at all-time new high. A higher close this week, and more specifically, a close above 31.57 is going to be huge, suggesting that we'll see the markets continue to scream out of this level. And the possibility on the upside now for this week is 31.72 to as high an extreme of 32.05. So we could see a really large rally come out of this. I don't think the Fed's going to say anything negative at this time, and it's going to be mostly all the market participants are going to continue to focus on the rotation that's been going on in the marketplace. The other thing that we saw, just a comment on some of the economics that are happening, we did see some of the European numbers start to improve. So if Europe starts to kick in just a little bit and some of their PMIs and manufacturing numbers start to improve a little bit, even if ours stay flat, I'm still expecting to see those numbers kind of move higher as we come into Q1 and Q2. I don't really see the manufacturing continue to be a drag on the economy. I think we'll see that turn around. And just a quick mention, I still believe that real estate's going to be a really big play next year. Anyway, we'll talk about that when I go through the 2020 outlook. As we go over and look at the intermediate charts on the long-term charts, you're going to see that this thing is just screaming out of here. We got a breakout last month. We had a reversal, a higher close for the second month. I'll highlight this. We had a reversal 2 months ago for the month of October. We followed through in November. Now December closes higher. We're going to see this just really start to scream out of here and accelerate to the upside. And the upside targets here, I've been talking about this for a while, is 34.77, and this is likely to be hit maybe before into Q2. And this will be a pretty substantial move, to say the least. Let's take a look, and I want to show you the spreads and what's. This is the IJR versus the S&P. See, we put a really nice basing period in here. We're starting to see everything turn up. All the indicators, everything's starting to show that we're going to move out of this level, and I expect to see this trend that we've seen going all the way back to basically a year ago. We're going to see this reverse and start to do better. Now the longer term elements of the market still suggest the S&P is going to be very strong, but these other, initially sometime in Q1 and Q2, we're going to see the mid cap looks like to be the potentially strongest, but also the small cap is going to show some pretty substantial moves as far as that goes. Let's take a look at that. This chart is the intermediate or weekly chart on MDY. And I've just put some Fibonacci expectations up here. And the move is expected to go toward somewhere between 369 to go to 382. This is the MDY ETF. And the possibilities of going as high as 453. So we're looking at a minimum of 3.5% gain. This could easily happen by year end, and then possibly going as high up to 453, which would be between a 8 and 10% gain as a target zone. And this would put us up at these numbers, and this will likely take anywhere from 8 to 12 weeks. So the better part of Q1 for this to happen. And this suggests there's some pretty substantial movement happening. We look at the IJR, it's the same thing on the intermediate with these big upward objectives. And you have to remember, we're a long ways from the actual all-time new high, which is what all this being projected at this time is. We're going to get back to the all-time highs on IJR and MDY. So we're a lot closer on MDY. Let me bring that back up just for a second. You see, we're closer, but we're still further away. So the projections for MDY suggest that we will see an all-time new high, and this is why I referenced a minute ago that I think the mid caps are going to do a bit better than the small caps initially, and I think there'll be a reverse rotation as far as that goes. But everything is basically still going to go up. There's not going to be much downside. All the trends are very solid. You look at the PPMs on all this stuff, intermediate, long-term are very bullish. Let me just flash up the mid MDY, and let's take a look at the monthly, and you see this is just a crazy explosive pattern. This is where the possibilities for this 453 number comes in, or about a 10% gain off of these longer term charts. So everything as we come into year end looks like we're ready to move higher. 2020, believe it or not, could be much stronger than what we saw in 2019. 2019, pretty good year. Part of the returns that we got from 2019 is we came in down so hard from the fourth quarter of 2018. So we started at a low point. But this is the breakout point where we're likely to see some huge acceleration on the upside. So this is going to be very exciting. Next, we'll take a look at the treasuries. And this is a 10-year daily, and there was quite the reversal after everything selling off a week ago Friday and coming into Monday. We saw the same type of reversal. So what we're seeing here is that interest rates going up, the stock market, equity markets are appreciating. These are going to go hand in hand. And this is why I mentioned early on in the opening dialogue is that there's a higher expectation for rates to go up next year than there is for them to go down. And what we've done, you can just see here on a daily chart, we got all the way down to 140. Everything got repriced. Mortgages, the entire economy got repriced for a moment. And that had a lot to do with the stimulus. Now, everybody's pointing to the Fed dropping rates. Well, I argued about this for a while, is that the Fed didn't need to drop rates because the markets dropped the rates ahead of the Fed. The Fed was adjusting to those rates. Now what's happened, we went from 140 back to 180, and we're likely to see this continue to move toward this 204 level I've been talking about for a number of weeks. So back to 2%, we'll call it. It's pretty substantial what we're seeing here. And it's most obvious when we look at the intermediate charts. You'll see here is this massive reversal that occurred last week. This is amazingly bullish, suggesting that the 2% is a point for it to pause, but most likely what we're going to see is a potential move all the way back to 220, 240. And I know you're not hearing that a lot of places, but this is likely what's going to happen. And it's going to be, these rates are going to be increasing for all of the right reasons. Those reasons are that the economy is going to be getting stronger. So there's going to be a play back on financials are still going to be in play. There's going to be, like I said, as the economy gets stronger, this secondary segment of the economy, which will be the mid caps and small cap stocks that have been lagging, will start to come more alive. And 2020 has just a huge upside potential in my view. But we see these things reversing, and when we go to the monthly and the long-term chart, you see we still have substantial resistance, but the next major point is that 240 level on the 10-year, which we're going to move back into this range. And really what we're seeing here is nothing more than a range between the, we'll call it, the high end's been 303, the low end's been 140, but if we block this off a little more toward the bottoms, we're really looking at the 160 level to the around the 275, but like I said, 240 is going to be these values right here, where the 21 and 40 moving averages are going to be where this stops. Let's take a quick look at the yield curve, which I've blown up so you can see a little better. This was some of the things that we're seeing here. We've seen some crazy moves here in these interest rates, but everything is starting to steepen now. And what's happening with the 13-week T-bill is going down, while the 5s and the 10s are steepening. And this is, like I said, just my expectation for these intermediate and longer term rates to continue to move higher. We're likely to see the 30-year back around the 280 level or higher. And even though this is going to cause ultimately a increase in mortgage yields, it's not going to have a substantial impact on the demand that's happening in the markets. I bought a house in California once. I paid, I think it was 11.5 or 12.25 rate, and the market was very strong back in those days. So when the jobs are good and the money is flowing, people will pay what they need to pay to get in a house. And anything at the rates that we're now is very cheap. So it's not going to be a hindrance to any of the economy as far as that expansion goes. All right, let's move on to the dollar. The dollar continues to be range bound, although it got a little bit weaker last week, but we saw a reversal on Friday, and we're likely to come back and remain between 96.30. I talked about this a couple of weeks ago. 96.30 and around 98.50 is the top end of this range. So we're going to remain stable. This is most likely what you're seeing is a sideways pattern setting up on the markets. And we look at the intermediate, you'll see that the intermediate shows this range. We saw a little spike above on the upside, but all the moving averages and everything suggests we're going to remain above the 96.5 level. And so the dollar will remain very stable. And then monthly just shows us just more of this confirmation of what's going on in the trend. You see 10-month moving average has been the primary trend line as it goes up, and we're still at a plus 0.45 on ppm1, suggesting there's only about a 20% probability for a close below that line, which is right now the 97.24 level. So we're hovering right on it, but we're not going to close under it, not with those levels. And even if it did close slightly under it, it will rebound as we come into 2020. Taking a look at the short-term charts on gold, this has been an interesting market. I've talked about this in commentary that the 1490 level was resistance. It got up to 1489.90 and reversed and closed on Friday at the 1465.10 level. We're down just a little bit right now, but this is most likely going to test this lows. We're still seeing momentum is very mixed, so it's hard to call a bottom here, and there's still some vulnerability to the downside. And this is actually more evident when we take a look at the intermediate charts. Intermediate charts are still showing some acceleration to the downside. That resistance that I talked about, 1490, is the 10-week moving average. This week it's going to be 1484. So we're going to see that resistant number come down about $20 above current pricing. But most likely we're going to see a new low in this pattern, and we'll move down toward the 1424 to around 1415 level, and we'll see a bottom set up there. And that's going to actually represent pretty substantial low and probably an opportunity to be looking to buy back in the gold. We'll take a look at the monthly and the long-term charts. We've seen quite a bit of dissipation of the upward momentum, but it's still very solid. We have ppm1 now at 0.82 positive, 0.32, and ppm3 is flat, which is the 40-month moving average. As we look at this data, you'll see that the 40-period movage now is 1355, 1351, but that 10-period moving average, or the 10-month moving average, 1420, and that's up at 0.82. So there's actually less than a 10% probability that for the month of December that we would close below this level. So gold looks pretty strong, pretty solid as that level goes. Finally, we'll take a look at crude oil. We saw a nice rebound last week. We once again got down to that 55 level and rebounded sharply all the way back up to 60. And there was pretty major news. OPEC has announced that they're going to be cutting production quite a bit. It makes it much harder for them to manipulate the market, with the U.S. now being the largest producer on the planet. And so the bottom line is that this pattern is pretty bullish. The dailies show a nice rally back. When we look at the intermediate, we're starting to see this pattern setting up much more bullish. I've talked about this quite a bit. Let's put some Fibonacci projections up on the screen here, and just so you can see exactly what is possible here. So we'll put up the ratios here, and what we're looking at is the high target is for a move to the 61.22 minimum, with the possibility of going as high as 67.57. I continue to be overall bullish on crude oil, and this is most likely has to do with the economic outlook that I've been talking about. Even though interest rates are going to go higher, everything's going to move to try to normalize in the market environment that we're in. You know, we have not, didn't even touch on any trade war stuff, because it's important to understand that the trade war is important, but it's not material, especially in as far as crude oil goes. Let's take a look at the monthly graph, and you'll see just more of a confirmation of what's happening here. I've talked about this a lot. This is an incredibly bullish pattern. The absolute minimum that we should expect to see is going to be a move back to around 75 to 78, and then ultimately we could see the markets move back all the way to the 92 level, and we'll see what kind of Fibonacci projection going. There's a pattern here. When it sets up, it's going to give us easy swing objectives to around 84 to about 95 level. So it looks to me that we'll see this 200-month moving average at some time. This will complete the broadcast. Thank you again for watching, and we'll see you next week. And remember, it'll be the final broadcast for the year. Thanks a lot, everyone. Talk to you soon.